Hey Nick, how you doing today?
Doing great, Dave. How about yourself?
I'm doing fine. We are sitting here at the end of the first quarter. Actually, we're a few weeks past the end of the first quarter, but it's time for our quarterly market review.
That's right. First quarter 2021 in the books,
Yeah,
and some good stuff. Some stuff that probably bears more watching, but definitely
yeah,
pretty decent quarter.
yeah. Decent is one way to put it. It's been things have just continued to go well as far as the stock market goes, and one of main the main themes that we hear from clients and people we talk to is how can the market be as good as it is, and how can things keep going the way they have been.
Yeah, and that's probably something to do with the separation between what you might see on an everyday basis and what the market views as good versus bad. And keep in mind that the market's looking always forward looking, so 6 months
Right.
out is what it's going to be, not necessarily what you see or are experiencing right now. They're forecasting kind of 6 months into the future. And so if you're asking the stock market what it thinks of 6 months from now, it thinks things are going to be pretty good.
Yeah, yeah. So I think the best way to kind of walk through that is talk about the good news and the bad news as far as what's out there right now, and how the market's behaving and how it looks. And the first item on the good news side is that the COVID-19 vaccine and distribution seem to be ramping up, and hopefully we are going to see the light at the end of the tunnel here. Or we already are seeing the light at the end of the tunnel, right?
Yeah, so I know that vaccines continue to go up. We continue to break records in terms of the number of vaccinations on a day-over-day basis, and that definitely has the markets thinking that potentially we could get past a lot of this. And I think in correspondence, some of the numbers are coming down in regards to that as well. And so from the market perspective, that's great news.
Right, right. And again, on a local level, it's kind of hard to tell because we're sitting here in Michigan, which is kind of ground zero for the country right now. But
Yeah, Michigan's teaching lessons on what not to do right now.
right,
Unfortunately, with a lot of the variants spreading and a lot of the numbers going up, and that debate on whether or not to close or to remain open
right,
is nothing, no more present than what's happening in Michigan right now.
right, right. And so with the expectation that economy is going to, or the life in general will return to normal here in the near future, we're expecting economic growth to accelerate throughout the rest of the year. um, Especially in America, where we've seen record levels of government stimulus.
Yeah, and from the sounds of it, more on the horizon. If
Mhm.
our current president has his wishes granted, looks like big spending on things like infrastructure and other things along those lines that could
Yeah,
continue to kind of push some of the economic growth forward, at least in the short term, for sure.
right, right. And so, we would expect as that stimulus takes effect and as people start going out and spending their money again, that we'll see a rebound in global economic activity that will produce strong earnings for cyclical companies, and companies out there that have been badly hurt during the pandemic will start to see things reverse for them.
Yeah, and what happens globally will be interesting. I've been listening to a couple of podcasts recently on what's going on with India, and we're certainly not through the pandemic, but as we get through it, the global economy should, return to more of a normalcy and continue to push growth.
Yeah.
Especially as, demand for certain things start to ramp up and hopefully supply goes along with that. That really should push global economic activity forward.
Right, right. And, as part of all that government stimulus, we're seeing the Federal Reserve keep short-term interest rates very low right now, as low as they can go, pretty much. So we've got monetary policy that's really geared towards fostering more economic growth. And despite, record levels of debt. We're seeing the Federal Reserve basically keep their foot on the gas.
Yeah, and this, has wide-reaching ramifications. Obviously, one of them is your savings accounts aren't earning a whole lot of interest.
Right, right.
But the flip side of that is mortgage borrowing, car loans are also very low, and so we've seen the housing market really take off as far as the residential housing, and to the point where it's causing price increases in lumber and things of that nature that we've never quite really seen or experienced before. So, that definitely has a wide-reaching ramification, but a hot housing market is usually a good sign for the overall economy.
True. Yeah. And, all of these things together kind of go to answer that question of how can the market keep doing what it's been doing here really since late summer last year. There's been this air of disbelief. But there's an old adage, an old cliche amongst market folks that says basically don't fight the Fed. And when the Fed is saying, hey, we're going to do everything we can to stimulate the economy, the market's going to respond and the economy's going to respond, and don't fight it, go with it.
Yeah. Yeah. And they're definitely, going out guns blazing with a lot of that stuff, and kind of the combination of not only the Fed, but also the government, when you have economic stimulus and low interest rates, it's kind of a double whammy, and the market is responding accordingly.
Right. Now there's a flip side always, right?
Always some bad with the good.
So on the other side of the scale, the virus does continue to evolve. We're seeing very dire circumstances in India right now, where a couple of months ago it seemed like they had the COVID situation pretty much in hand, and so there's always that concern globally that we could see things turn and new variants and what have you.
Yeah, and a great example of how connected we are in the world right now when it comes to things like distribution is the canal, when the ship got stuck in the canal,
in the Suez Canal.
Right? Yeah, and which is something that we never really, probably, I'm not sure if it's happened before or not, but it's something that just that one ship being stuck caused massive problems from a distribution standpoint.
Right.
And so the same could be said is if we have more lockdowns in countries and regions, that could continue to affect potential economic growth and development because of the supply chain and the issues with that.
Yeah. And, so there's some concern about inflation and what that would mean for the economy and the bond market with all of the stimulus that we've got in the pipeline, and with the Federal Reserve committed to very low interest rates. The flip side of all of that is that all that money flowing into the economy at once can create inflation beyond the norm.
Yeah, that's, and interestingly enough, hard place to be in the Fed's shoes, as their number one task is always inflation and keeping inflation in task above everything else.
Right.
And so now they're kind of in the standpoint of how far do we push this, knowing that inflation is probably going to result in the things that we're doing right now, and where do you draw that line, and when do you start to pull back, and how does inflation affect that? So that will be interesting to watch going forward for sure.
Right. And now what the Fed's response to that question would be that, the inflation that we may see here in the short run will be what they call transitory, and really is just making up for the inflation we didn't have last year. So, it may be higher, but it makes up for a period that was lower, and we end up with an average that's right about where they want it to be. So far, over the last several years, the Fed has done a pretty good job managing inflation. I've heard, different opinions on that, but, by and large, I don't think we can complain too much. It's always a question, though. It's much more of an art than a science, I think.
Yeah. and nobody really knows the true answer to what buttons they're pushing and how they're going to affect things, and so it's really kind of a guess and check. And I
Yeah.
would tend to agree that I think that they've done a good job of that.
Yeah.
Whether it was them or kind of how things played out is a different conversation. But so far, we haven't really had inflation as a concern for a long time.
Right. Right. And so some other things to keep an eye on. We've seen a rotation in the markets, and some folks see this as a potential problem. Others see it as a potential bullish sign. But really, we saw a narrow group of large companies, growth-oriented tech companies, lead the way over the last several years, and they've kind of struggled so far in 2021, relative to the broader market. So that's something to keep an eye on. Maybe some leadership changes. I view that as a good thing if we're seeing the rest of the market still rise. That seems to say that investors are looking for other opportunities.
Yeah, I kind of view it as a good thing as well, and it's interesting the dynamic of what's going on with those bigger FANG stocks, and the potential of antitrust and breaking them up, and there's a lot more going on than necessarily their profitability right now. But I do agree with you that I think it's a good sign that we're seeing some other companies and industries really do well as we kind of come out of the pandemic.
Yeah. And the other thing to kind of keep an eye on that kind of goes with inflation, and whenever we're talking macroeconomics, these things all kind of fit together like gears. But if we see that higher inflation, we're going to see the bond market kind of struggle too. So when we see higher inflation, we'll see higher interest rates eventually, whether the Fed wants it or not. And the bond market already, we're going to look at numbers here from the first quarter, but we saw the bond market lag pretty badly in the first quarter of 2021. And if we do see signs of inflation, we'll see more trouble there, no doubt.
Yeah, and that's one of those that is good news, bad news as well, right? So if you're trying to play the timing game, you're trying to time that out. But the flip side of bonds and interest rates rising is, yes, bond performance goes down, but it's in conjunction with stock prices going up, which is kind of exactly what you want when you're building a diversified portfolio. And it also means that if things turn around and go the other way, there's some room for bond yields, interest rates to go down, so bond prices can go up when the stock market might not be going up.
Yeah. Getting back to something other than extremely low interest rates is actually good for the economy overall. For exactly what you're saying. Yeah.
Just painful to go through sometimes, especially depending on how much you have in bonds and bond holdings. So
Right. So if we look at how the first 3 months of 2021 played out in the broad U.S. stock market, we saw gains of about 6.35%. That's using the really broad Russell 3000 index. It's kind of the best measure. And we saw international developed stocks be up about 4%. So, that would be good solid returns for the year, but that was just a quarter.
Yeah, and impressive returns coming off the fourth quarter of last year, which was also very, very good. So kind of back-to-back good quarters.
Yeah. And the one from this quarter that kind of surprises me with everything going on and the changes in the economy is that global real estate was up almost 6.25% for the year. And that's not one I would have expected with the fact that interest rates did rise a bit during the first quarter, and we're going to talk about bonds here in a minute, but with the shifts in how we're using office space and those kind of things, I guess that's offset by the housing market, in a lot of respects.
Yes, definitely an interesting dynamic. Another thing that's interesting, just looking at these numbers here, emerging markets were up slightly, but compared to the about 2.2% compared to international and U.S. stocks, which were up 4 and 6 respectively. And I think that just speaks to kind of the disparity in some of the more developed nations to get the vaccine, get
Yeah,
things kind of stabilized, where we haven't really seen that to the same degree in the emerging market sector, and probably part of the reason for the lag there.
right, right. Meanwhile, domestic bonds, American bonds, were down about 3.33% for the quarter.
Another, like we talked about with interest rates going up, bond prices go down, and that's kind of exactly what we saw last quarter.
Hmm. But kind of to talk again about that, what that means in the long run from a technical standpoint. So one of the indicators you use to try to measure the health of the economy is what we call the yield curve. That looks at how bonds of different maturities compare to each other. So we look at really short-term treasury notes compared to the 10-year, compared to the 20-year and 30-year bonds that are out there. And going into this quarter, we had a very flat yield curve, meaning longer-term bonds weren't yielding much more than short-term bonds. And we've got a situation now where the Fed is pledged to keep short-term rates really low, but we saw long-term rates, which is reflected in this -3% for bonds during the quarter, start to come up. When bond yields come up, bond prices go down.
Mhm.
So we're starting to see that turn into a more normal yield curve, where further out you get higher interest rates for investing longer term. And while, yes, we had to see the bond market drop 3% to get there, in the long run, a normal yield curve is actually a sign of expectations of a stronger economy down the road. Where a flat yield curve like we had still shows that people are really worried about where the economy's headed in the future.
Yeah, so, like we talked about, it's just because the bond market is down doesn't mean doom and gloom. We've actually some good
Right.
positive things coming out of the quarter, even though bond prices have gone down as a result.
Yeah. Yeah. So, the we always like to look at where things were a year ago, and if we
Yeah.
if we graph out the market returns from March 31st of 2020 to March 31st of 2021, 62.5% for the U.S. stock market. But the timing of that almost with I think the quarter ended a week after the bottom of the market
Right.
last year. The market
Yeah.
bottomed out around March 23rd. So, while it's kind of neat to look at those numbers, they're, not very meaningful.
Yeah, the 1 year numbers are definitely skewed, and it doesn't happen very often that we get like the perfect timing of when the market bottoms out at the
Yeah,
end of the quarter so that we can come back with 1 year numbers that look kind of outrageous. But
yeah,
it is what it is, and which is why we never put too much stock in what happens in the short term, 3, 6, 12 months,
hmm,
because that can be very subjective to when the quarter ends and what the market did previously. And so always looking kind of at the longer term numbers.
yeah.
Um,
Now,
and so, but that being said, great recovery, and things
yeah,
went fantastic last year after we kind of bottomed out for sure.
yeah, and but interesting too. So on the same chart, we've got the 10-year U.S. stock market return, and it's 13.79% for the last 10 years as an average. And so that gives you an idea of how performance since 2011 has looked when you compare that to the long-term average, which, depending on what you want to count. I know for the S&P 500, 10% is a pretty good rule of thumb long-term average. So we're seeing that outperformance.
Yeah, it's very interesting when you look at this chart, when we start looking at the 5 and the 10 year numbers. The U.S. stock market outperformance, especially when you look at the numbers of the international markets and the emerging markets in that same vein, because those 10 year numbers are much lower. I mean, international developed did 5,
Mhm.
emerging markets did 3. And so this is where diversification is important, but also hard to do because you look at these numbers and you say to yourself, man, why don't I just have everything in the US stock market?
Right, right.
And unfortunately, if you had that same conversation 10 years ago, good on you for being exactly right. But the chances of that are slim to none.
Yeah, yeah,
And
yeah.
these things are cyclical. We talk about it all the time where the next 10 years, it's probably not going to be the US stock market that outperforms. But instead of trying to figure it out, having a diversified
Yes.
portfolio with international, developed, and emerging markets, you know that your average is still going to be a really good return, even if it's not
Hmm.
going to be the best one out of all of those.
Right, right. You know, that one thing to keep in mind is when we have when we build these all of our clients are in some form of a diversified portfolio that includes stocks and bonds.
Mm.
And so even with negative returns from the bond market for the first quarter of 2021, even the more conservative models that are mostly in bonds still showed positive returns, which I thought was interesting with the bond market being down 3.33%. I was pleasantly surprised to see that.
Yeah, yeah. And that, just speaks to the importance of diversification.
Hmm. So one thing that we kind of noticed over the we're really going on about 6 months now with the changeover in market leadership,
Mm.
and it became even more pronounced over the last couple months. But small companies that are value oriented. My wife's dog just opened my door and walked in the room.
I heard his pause.
Yeah.
And let's see, 22. I'll mark that down for a minute.
Thanks.
Yeah.
I'd have to put a chair up against a barrier. All right. So anyway, so when we look at the measure of small companies, and particularly what we call value-oriented small companies, so stocks of companies whose share prices are low relative to their earnings, we actually saw 21% returns for the first quarter.
Yeah, that's incredible. And if you are joining us on YouTube, and we'll probably have a link to this, we will have
Yeah,
a
well,
link to this in the show notes. But this chart just kind of is mystifying to some degree when you look at what the small cap value index has been able to do compared to everything
mhm,
else. And
mhm,
again, I keep harping on, I'm going to sound like a broken record about diversification, but if you look at that, US 10-year return, well, that's a combination of large, mid, small cap, value, growth. And so even inside of US stock market, there's still decisions to be made as far as what you own and what drives
mhm.
that. And you really can never tell what's going to be that big driving force that particular quarter, that particular month. This month, it was obviously small cap value, but that previously large cap growth had really been dominating for a while.
Yeah, yeah, and it's interesting if you look historically, the best returns over history have always come out of small cap value, but it's been a long time since it was the leader. But now it's the leader by almost a 200% margin. So
Right.
well,
Yeah.
see how it plays out over time. But it's just interesting observations. But really, what everybody wants to know is where are we going from here, right?
Absolutely.
So
Yeah.
where are we going, Nick? What's next?
The $1 million question, which is why we never
Right,
try to predict it because we can't, right?
right.
And the other, just going back to that slide, the other part of trying to predict and project is if you're wrong by one quarter, that's a
Hmm.
huge difference. It's a huge part of the growth for small value is probably going to be what happened in that 21% quarter. And if you miss it, it's hard to catch that up and make that back. So that's
Yeah,
why
yeah,
holding a little bit of this, a little bit of small cap, a little bit of large cap, and making it appropriate to your risk level makes all the sense in the world. Not trying to be the hero, just trying to get, the return that you should, not necessarily more
right.
than that. Not
You
chasing
know,
returns.
there's the really popular chart. I hear some advisors call them quilt charts, And I didn't include it in this slide deck, but remind me later this afternoon. I will add it before we post this to the notes, where it shows it in colors how the market leadership changes year over year. Like,
Right.
and you really see that there's very little predictability or pattern to
Oh yeah.
which asset class is going to be the one for the next
Right.
quarter.
Yep.
So yeah, you just aren't going to know, and so you diversify and be smart about portfolio construction. And the big thing is like now, when you consider what do we do right now? Well, the stock market, it's been a little bit unbelievable, but the bond market's down. So what do? We rebalance, just like our
Yep.
normal discipline would tell us to do, which means we're taking some of those profits out of the stock side and putting them back into the bond side that's down. Because when the winds of change arrive, we'll have bought lower and be selling higher again.
Yeah, I mean, the beauty of rebalance, right? It forces you to, on a systematic basis, buy low and sell high, and that's exactly what you want to be doing.
Yeah, yeah. So we'll see what the next couple of months bring, and see where we stand next quarter. But off to a good start for the year, and cautiously optimistic about where we're heading.
Yeah, definitely a good start to the year. If we would take this start to every year, but we'll definitely
Yeah.
definitely take it in 2021 and kind of see where things go from here. But like you said, it's a good start to the year, and hopefully we can kind of continue to see the economy rebound and recover, and the stock market reflect that.
Yep. Sounds good. All right. I
Always a
will catch up with you later.
always a pleasure, Dave.
Thanks.